Hey guys, this is Scott Horn with G.O.A.T Funding, LLC, and we're just going to take a minute and talk about bank financing versus hard money lending, and I'll even throw in there maybe a little bit about DSCR lending. Each of these is something different to consider on your deal. So if you like the video, guys, please take a minute and like it. Make any questions below for us, and we'll do our best to get back to you on those. And we hope you come join our YouTube channel as well. So there's always a question about when to use various types of financing. And one thing I do when I'm talking about money is, my first comment is money is not necessarily about the cost of money, it's about the availability of money. And when you're buying a property, it is so important to have access to capital. If you're not going to buy it creatively, even then you got to have access to some capital to bring the loan current, to pay the seller, to handle your closing costs or renovations. So that's either going to be your cash or private capital in most cases in those instances, but it's always about the availability of money. And so often in our investment world, things move so quick. Going to a DSCR lender per se, for a national mortgage hard money lender more or less, may take 30 or 45 days to get that loan done because of appraisals, underwriting, and things of that nature that are out there. So that might not work for the deal you've structured between you and your seller. Well, obviously going to a bank is going to be cheaper than going to a asset-based lender, but if you go to a bank today, you're looking at 20 and probably 25% down payments of cost, not the after repaired value of the property. So the first question is do you have that money, or can you borrow it from another second lien lender of some type, such as a private lender? Then on the other hand, we have our hard money, and hard money oftentimes is going to base their numbers on the after repaired value of the property, not the cost. And so it's going to greatly minimize the amount of money you need to put down. DSCR lenders are going to require usually a minimum of 20% down payment at closing. And I know there's a lot of ways that people are trying to figure out how to reborrow that money from either private lenders or even from the seller themselves after closing. Got it. But it's still money and obligation you need to borrow in some format. Going into a bank, that 20 to 25% down, now at banks, it's going to be a credit-driven loan. It's going to be credit-driven, it's going to be asset-based driven, they're going to see your history. A lot of things like that banks are going to ask for. So why use a bank in that instance? Well, you're going to get a lower interest rate, lower costs, things of that nature, and better terms both short and long term with that bank. The DSCR lender with that 20% down may not be looking at your financials per se, but they are looking at your credit. It's going to be a credit-based loan. And they're looking at the rental costs of that loan too. That's the credit ratio, or excuse me, the debt service part that they're looking at along the way. And all that has got to mesh to get the right type of loan, because if the rents are maybe depressed in this particular area, that 20% down payment could very quickly become 30 or 35 or 40%. So hard money fills really a necessary role in the real estate investment industry. It's there for quick and typically easy access to money to buy and control that house. It may limit the amount of money you need to put down. Here at G.O.A.T Funding, we base our G.O.A.T loans on the after repaired value. And if you're buying that property, all in, purchase price and repairs at 70%, you're putting $0 down at closing. A lot of other hard money lenders have a minimum 10% down payment of your purchase price regardless of what the value is. It's just a way to minimize their risk and to run a little bit lower loan to value. So I get all that. Hard money can close your deals typically much faster than a bank or a mortgage loan. They can close in as little, typically as a week or 2 weeks, and get you in and get you out. Yeah, the interest rate might be higher, but when you use hard money the right way for a short time frame, that's why it's there. You don't use hard money for a long-term loan. You're going to spend a lot of money on interest, points, and fees along the way if you do that. It's just not there for that purpose. That's why you have DSCR and bank loans, is for your longer term stuff. A hard money loan is there to get you in and out. So you're ready to go to sale quickly, ready to get the house renovated so you can then refinance it quickly. It'll pass appraisal standards that it may not pass with a bank or with a DSCR mortgage type loan. And it serves that necessary role. So many people come in and say, oh, the interest rates are too high or this or that. And it's like, whatever. You know, it is about the availability of the money. It is about the cost of the money, but when you look at it over the scope of 4 to 6 months, which is what hard money is really designed for, if even paying 1 or 2% interest rate higher than a DSCR loan or 4 or 5% higher, it isn't a lot of money. And too many people wig out over that little bit of additional cost, realizing that it's about the availability. It's not necessarily about the cost. It will help you navigate that mentally. And too many people get caught up on those things. I always tell people that when you're looking at using a bank loan versus a hard money loan per se, that if you can go to hard money, but it's going to cost you $1,000 more in fees over a certain time frame than going to your bank, but you don't have time to go to the bank, so you can't even buy the property, and you're going to make $10,000 profit. So you'd make $10,000 if you're going to utilize the bank loan, but maybe only make $9,000 profit if you're going to utilize the hard money loan. Well, if you can't get the bank loan and get it closed in time, meaning you can't get the deal controlled and bought, you make zero. So the question really becomes, do you want to make $0 or $9,000? Guys, it gets really easy and simple when you think that way. There's a time and place for all of that. If you want to use a bank loan, get it set up, get it ready to go, be in place so you can move on it quickly, because a bank can usually close in about 2 weeks. If you want to use a DSCR loan out there instead, get your applications into your lender, have them updated on a regular basis so they have what they need. So if you do get a contract, you know your time frames, you know what that's going to look like, and you can get it going quickly. On the flip side, the same thing with a hard money loan. If you get the deal done and need access to that capital, the application process is usually very simple. The inspection time is very quick. There may be an appraisal, there may be a broker's price opinion involved in most cases. Those can happen very quickly, and that closing can happen usually by the time title is ready to go, or within a few days thereafter. If you got your contract, if you got your repair takeoff, you got those kind of things, then hard money oftentimes is the way to go for ease of operation. So guys, I hope you found the video helpful. This as a discernment between the 3 primary types of financing we have in our investor marketplace today. If you did, take a minute and like the video, please. Give us any questions below. We'll get back to you with answers on those. Come see us on our YouTube channel. And guys, we'll see you guys next time.